Great to see you, Jeppe. Great again to see you. I'm saying it again because it's like a really, really exciting, webinar. This webinar, obviously, we've done some webinars in the past, but this one I look at it as a bit more exciting than the rest, as you are approaching $100 million of AUC, assets under copy, which is an amazing milestone. I'm super excited to have you here with us. It's important to know to whoever is, all of you guys that participate in this webinar that in mid-January, Jeppe minimum copy amount would be $20,000, meaning you cannot start copying him with less than that from the mid of January. So if you want to copy him with less, you should do it as soon as possible. If that's what you want, obviously. And yeah, super, super excited to have you here again with me and, to discuss it. What a milestone. Jeppe, how are you feeling?
Yeah, very good. I'm very happy. Thank you. How are you?
I'm great. I'm great as usual. Super, great. Obviously, to the people who do not know Jeppe, which are a very small amount of people do not know Jeppe yet. But, I would love to hear it as well. Just, to kick things off, can you share a little bit about your background, what initially drew you to the capital markets? Just share a little bit about yourself at the beginning, back then.
So all the way back, my dad, he was a politician in the European Parliament for 29 years. So I guess I thought I was just going to be a politician as well. But then along the way, I got more interested in finance. And so I did my master's degree in finance. And then I started work as a management consultant, advising some of the largest companies in the world. And there I really mostly did valuations. So analyzing companies and calculating what they're really worth. And then as I was doing that, I was making more money than I was spending. So I wanted to invest my money. And then I researched all the different brokers and scored them on all the different factors that were important to me, like what instruments are available, what are the prices, how good is the app, how good is the website. And then after weighing all those factors, eToro came out on top. And then I started investing on eToro. And then eToro has this feature you could enable where people can be allowed to copy you. And then, I got 1 copier, then 10 copiers, then 100 copiers, then, friends and family saying, oh, yeah, but we are copying you now. And then in 2018, I decided to just focus only on managing my investment portfolio. And then I hired some people and got some improved tools and quit my consulting job to just only do that. And
Wow.
then one year later, I was then
consulting job.
Huh?
When you say consulting job?
Yeah, I quit the consulting in 2018.
Oh, amazing. So you worked as a consultant at...
Yeah, in the beginning, I was doing the consulting and eToro, and then from 2018, only eToro.
Amazing. Okay, continue.
Yeah, and then 1 year later, I was most copied on eToro, and then that's been the case since then. And most of my career was in London, but 3 years ago, I moved to Dubai.
How is that?
I love it.
That's amazing. Dubai is amazing, obviously. London is amazing as well. Just the weather is a bit problematic, obviously. So I would love it if you can elaborate on your investment strategy and how you developed it over time. What makes it unique and sustainable as such, high level of AUC?
Yeah, so I guess my real specialty area is the intersection of politics, finance, and technology. There are a lot of people, well, not even a lot, but there are some that know a little bit about 2 of those things. But I think there are very few that understand all 3. And there are many of the most important companies in the world where you really need to understand all 3. Otherwise, you cannot really assess the value of that company because, they might look good on 2 of those things, but then they're actually not great because of the 3rd one. And so that's sort of my special area. Then in terms of my investment strategy, I focus on long-term. I focus on stocks. I focus on fundamental analysis, so really analyzing companies carefully. What's their financial statements been like? What's it like to be an employee there, a customer there? What are their products and services like? What is the management team like? What can they do in different scenarios? How is their technology stack? And all of those things to really assess how much profits can this company create in different scenarios in the future. And based off of that, what should I really be willing to pay for their share today? And then I make a portfolio with companies that I evaluate are worth a lot more than their price would indicate, that fit together risk-wise, so that, I have some companies that would potentially do well in some scenarios where some other companies will not do as well. And then that sort of keeps me in a sensible position where I'm at my risk appetite.
Amazing. Amazing. I think it's extremely important, to use all of the three and not just one. I usually, personally think that, to use only one method for investment, it's a bit like missing something. So I think it's always important. Obviously, I highly believe in fundamentals, and I know what researches you're conducting. I know you, for a while already, and obviously I know that each company that you have very deeply. By the way, I see that some people are writing and like raising their hands. So just like feel free to write whatever you want to write in the Q&A. We will address. We will try to address all of your questions later. In the end, and obviously, if you want to ask Jeppe, later on, you can always pop up to his eToro profile. So regarding the investment process, like I understood how you conduct the research, but I would love it if you can just walk us through your investment process. Specifically, how do you decide which, position to open, when to open them, like when to close them?
Yeah, so I automatically source data on more than 2,000 companies. So yeah, I've just built my financial models over the last 12 years to really, have them organize that data in a nice way that gets me to see all these companies and how they stack up. And then I'm always building on that framework because with every company that I deep dive on, I always learn something new. There's something special about every company. So for instance, when I 12 years ago invested in Facebook, I didn't just learn about Facebook. I also learned about this new concept of social media advertising. And then I evaluated, oh, what kind of companies are good at social media advertising? Oh, that seems like the smart companies. Okay, maybe I should start using this whenever I value companies. And so over the many, many years, there's just been more and more things where I'm like, right, that thing I learned from there, I can see that's happening over here. And then to complement all that data that comes in automatically, there is all my subjective data. So it's numbers, but it's still subjective. Like how much do I like the CEO on a scale from 1 to 10? What do I think about this new product on a scale from 1 to 10? So there can be a lot of subjective numbers that come in like that, but they ultimately are part of me assessing companies. And then I can always rank the companies from how good investments they are and how they fit risk-wise together, and then ensure that, every day the companies that I have in my portfolio are the ones that are at the top of that list. And then out of the 2,000 companies, there's 180 that I've sort of focus on. So those are the ones where I stay on top of news and will pay more attention. And then sometimes some companies are removed from that list and other ones are added. And then that's sort of how I do it. So sort of about 2,000 companies in my universe down to 180 that I analyze carefully to 53 in the portfolio.
That's crazy. And I think like it's funny you say about liking the CEO. I wonder, when you say liking, you mean in terms of like his ideas, his approach, or also as just like someone that you think also will, push the company forward in other aspects, etc.
Yeah, so that's broken down into further medicine. For fun, I added one about how good the haircut was at some point. So it could be something as little that. But of course, the more important things are whether the core key question is, I imagine that I am coming into this company as a management consultant to advise their management team. And then there's potentially a strategy that I would want them to do. And then sort of the key criteria is that really the strategy they would do? Sometimes I see a company that does have a potential, and I think if they do this, this, and this, then they can become really, really massively profitable. And then when they sort of start going away from that and doing something else, and like, right, that's not how I would do it. So then they're out. And that's sort of that I put very much on the CEO. Of course, it's the whole management team, but sort of they are the ones that are where you really got to hear what they say and see what they're doing. And then yeah, even though, you're not just yourself, you're also your network. So some of that sort of spills in, and then you got to, yeah.
Yes, we all know like sometimes there's like the management saying some one thing, the report saying another thing. So it's always important, as you said, to combine all of it, not just look at one factor and say, okay, it looks good. No, you also need to look at the management. Do you like the management? Do you understand? Do you like their approach? You like how they work? And we all know how important is the CEO, and I think even crucial in this things. So I think like, obviously we're approaching the new year and it's extremely exciting. Like, I cannot believe we're in 2025 already. I am still in 2017. But I think I would like to hear if you have any insights on specific companies, sectors, trends you believe will be, let's say, significant over the next 5 years. And obviously, what gives you the confidence in these opportunities? Obviously, it's not an investment that you
Absolutely most important thing happening is artificial intelligence. And I think that's what's going to make the world look completely different in already probably 5 years. And the companies that are driving that or have the potential to really benefit from that, I think they can reach absolutely incredible levels of profitability. In sort of a lot of people, they cannot really comprehend that a company can become very big and profitable. They're just like, well, companies can't become so big. And like, I mean, if you had been 100 years ago and you had told people how big like Standard Oil could become, or, when I first invested in Facebook, told people like, how big this could become, people just can't fathom that. It's like, no, maybe they can become as big as a newspaper or something. But obviously, Facebook can't become, like giant. It just can. Like, if you can create a company that can actually just do so much work with AI and just absolutely save so much money for other companies with this, you can make an incredible amount of profits. And that's then if you look at some of the companies here that are actually already quite decently profitable from their current products with incredible growth rates and quite sort of clear technological trajectory for this to work out, then those are just absolutely, in my opinion, undervalued. And I think it's both underappreciated in terms of the monetary value from this, but also in the terms of societal impact. And then finally, also in terms of actually danger. I think there's a big danger from AI as well, and that's sort of also underappreciated.
So when you say danger from AI, can you elaborate on this?
Well, so there are sort of different levels. The most important one is the extinction risk. Effectively, there's a big case to be made that you can create an AI that sort of it only really needs to replace one job, which is the job of the AI researcher, and then that AI can just get better and better and better and better, and really sort of suddenly there are different sort of scenarios for how that can sort of run out of control. But I can definitely see in my head many different sort of sci-fi futures where you are just being ordered around by the AI more or less, and sort of humans are no longer really in charge.
Mm-hmm. So if we're looking at it, actually very interesting. It's very interesting. How do you measure risk in these kind of things? Can you measure the risk in the right way? Yeah. I would love to hear like if you have any lesson learned. So obviously we're talking, about the future and we're trying to figure out what's going to be, but we all know that a lot of lessons we learned from the past, actually. What would be your biggest mistake? I know this question is a bit, what would be your biggest mistake and what did you learn from it? And obviously on the other side, which investment are you most proud of and why?
Yeah, the biggest mistake is I would say, it's the investment I made in the Russian natural gas company Novatek, because, when Putin attacked Ukraine, that went down by 99% and got delisted. But the key mistake, it was sort of when I made that investment, I had put 30% probability that something like that would happen. And I had protected that position with aerospace and defense coming that then went up more to compensate for it. But really, natural gas went up as well. So I should not have had that big an investment in that Russian gas company. I should have had part of that in an American natural gas company as well. And that would have saved me a little bit there. So that's sort of like, that's just objectively. There are other stuff where like you couldn't have foreseen that, you couldn't have done that. But that's just like, why didn't you do that, Jeppe? There was,
I can
like,
always
come
say
on.
that.
You
I
let
say it
people
like
down.
a few times a day. Okay.
That's the worst one. The one that I'm proud of is Tesla. It's not the best one. The best one has been Nvidia, but Tesla is the one that I held on to and added to at the right times along the way. Whenever it really went down, when Elon Musk did something crazy, I added more, and it was the one that I was getting so much criticism for. I've sat in so many meetings with friends and different investors and whatnot, and been told like, clearly this shows you know nothing about investments. How can you be paying this much for a car company? Clearly, and at some point I just had to tell myself again and again, just like, I'm building the portfolio that these people think is the best one, or the one that I actually think is the best one, right? I'm going to invest my money the way I think I can invest in the best. And then that's sometimes going to be in something that people think seems idiotic. I'm like, right, I'll prove it wrong in the long term. And then sort of, it's been very nice for then Tesla to sort of, come around eventually and then sort of prove those people wrong. And certainly when I meet them again, they're like, looks like you
Why I
just
didn't invest in Tesla. Yeah, I think it's really, really. By the way, what did you learn from your biggest mistake?
What did I learn from that one? I mean, certainly if we face the exact same situation again, I'm probably going to be split across two instead of just one. And I think I did do sort of in because of that, I did go through an exercise a few times, sort of seeing, okay, what other things can I potentially sort of like cut the risk on that a little bit, saying if that extreme scenario happens, and then at the same time there's a big benefit somewhere else, can I sort of position myself a little bit more so that my loss on that one is cut, and I save on something else. Because I think that's it's sort of a subcategory of hedging your portfolio against different things. So for instance,
Mhm.
if energy prices go up a lot, well, I have companies that produce energy and use energy, so it's okay. But a very sad situation if suddenly, there's like a massive change in the world, and I'm just, energy prices are going up, but I happen to have all my energy in the wrong place. It's like, so yeah, you gotta sort of think that whole thing through in all the different scenarios for the future.
Yeah, and to be honest, I think you managed here two really, really important, things. Basically, handling emotions and risk management. I would love to start with like handling emotions. This is what you mentioned in the Tesla story, where basically, a lot of people told you, no, stop it. This is not the right thing to do. You don't understand an investment, and a lot of questions, et cetera, et cetera. So, handling the emotions and actually believe that what you did is right. How do you do that? Like, how do you deal with emotions? We all know it is such a crucial part in long-term investment success. So would love to hear your insights on that.
Yeah, so back in university, one of our professors, he showed us a list of 163 different cognitive biases. I think he'd picked some of them out, and I went home myself and looked at that list. And I'm like, right, okay, I gotta make sure that I'm not falling prey to these cognitive biases. And I saw later that the list had been expanded a little bit. They added some new ones they found, but for instance, like, okay, you'll be more prone to aggressive decisions if you're hungry. Like, okay, I can't have that influence my decision process. And then I think I've overall gravitated to a way where I have a long to-do list where I have scored everything I need to do by how valuable it is to me, and then how long it will take, and which day of the week it is, and how different factors weigh up and what's important to me right now, and so forth. Based on all of that, I rank my to-do list. So do I gotta research this company more? Do I gotta book a meeting here? Do I whatever I gotta do in the right order? And so I sort of tell my to-do system what I need to do, and then I just do what my to-do system tells me. And then similarly, I analyze all the companies, and then I see which ones I think are the best ones, and then I put them in portfolio. And I just sort of like do that. And then I don't get like too bogged down in whether the market went up or down. Like, right, the market went up. Okay, I got to look at which are the best companies in the current situation and have the best one. Oh, the market went up. Right. Well, I got to analyze the companies carefully and ensure I have the best ones. So the sort of small moments of joy or disappointment are not really related to the stock price for me. They're related to sort of actual things the company go out and do, whether or not those impact the price. So if the CEO says something that indicates to me they're going to go in the wrong direction, then I'll be like, oh no, this is the. But that might not show up in the price. But that's like, and similarly, like when I'm 80% through analyzing a new company, I'm just like, okay, they better not be bad this and this, but I can feel like, think I found one here. This is a goddamn good investment. Then that's when I get excited. Then it going up a lot later is sort of like, right, yeah, but that was thanks to the good research work I did back then. And, it being in my portfolio right now is thanks to things that I'm looking at right now. And so, yeah, somehow within that, it means that I'm not like sitting there looking at the price going, yeah,
Go down. Yeah, and I
yeah.
think like basically, as you mentioned, you believe in your initial decisions. And unless like something extremely, fundamental changed, you wouldn't just like change your mind because yesterday was, you know.
Well, that's the biggest difference between me and some of the largest investment funds. It is that they are always basically with a large chunk in bonds and a large chunk in stocks, and they don't care too much about them, and they don't think they found anything good. So any little change makes them overchange a little bit, overchange a little bit. But for me, I'll have a stock where I'm like in 2016 sitting on Tesla worth $5 billion only. I'm like, this company's gonna be worth so much more. So it's not like it goes up by 2%. I'm gonna be like, oh, Now I'm selling, or like, oh, it's down by 2%. Now I'm like, no, no, no. Like, I know this company is worth so much more than the price that I'm going to be having a big chunk of this. And then there might be something that, okay, now I actually need to have even more or less, but it's not at the same position. If you have something that that's worth $100 and you price at 99 going up to 101, then you'd be more like inclined to doing something all the time. But if you're sitting on something you think is a real like hidden gem, and then you don't care whether people are offering you $5 or $4, but like, yeah, you can go away with that little price there. I know what I'm having here. I'm gonna wait a few years, and then once their products and services are ready and they've done what they are setting out to do, then you'll all see.
Exactly. And I think like you always as an investor, you always need to remind yourself, I know what I'm doing. I decide, like I did my research and they were good, and I checked the right elements, and always trust what you did and not like shake a bit with every opinion or little thing that happened, which is extremely important. And obviously this brings us to what you mentioned before, the risk management, with such large AUC, so many copiers. I think more than 30,000 copiers copying you. How do you manage like risk management?
Yeah, so I use two different frameworks. I have my own, and then I have eToro's. So eToro's framework is a risk score from 1 to 10, where 1 is good and 10 is terrible. I think if you reach a 10, you are not allowed to be copyable anymore. You get 7, you get a warning. Thankfully, I have not gone to that level. I try to stay between 3 and 5. And then I do my own risk framework, where I do a lot of scenarios and do a weighted average across those scenarios to see how my portfolio would perform in those different scenarios. And then if I want to make a change to the portfolio, I see, okay, how does that change the risk profile according to my own framework? And how would that potentially change my risk score? And to make a change to the portfolio, it has to be good according to both of those framework. So it's like, okay, that looks good, but it wouldn't be good on that one, right? Then I don't do it. So it has to sort of make sense in both of them. And then I sort of have determined that I want to be at a risk level that I think is appropriate for myself and my friends and my family who are copying me. And then it's appropriate for many people. But of course, some people, they would prefer more risk or less risk. And that's how it is.
Yeah. And, obviously when you have so many copiers, you cannot please everyone. And as you said before, it is also really, really important to manage, the emotions also in front of the copiers as well. Because like when there's like a small drawdown, we all know like people are like, oh my God, I'm losing everything. No, it doesn't work like that. Not like in your first red month, which I don't think any investor had only green month ever. You should be stressed. And I think like this is really, really important for someone to hear, when you have such, big amount of AUC, it's extremely important, to always like manage emotion also in front of them. And obviously I see that you always like respond to messages, you're always on top of it to explain it to the copiers, which is also a big deal to do, right?
Yeah, often when people are sort of panicking over a small drop in the market or something, what people are really lacking is sort of historical context and the numbers of context. I saw one time one person said, "Oh, I just want to get a conservative 1% return per day." Like, do you have any idea how insanely high return that is? Like, your expectations are way, way off. And similarly, people are panicking about something that happens in the market on average every 3 years. It's like, right, if you look at financial history, like this is really, really normal. You have to, if you're investing in the stock market, you are being basically given a high average reward over time for taking on this volatility. In the same way that an insurance company can be very profitable by saying, yeah, we'll suffer sometimes when bad things happen, but every year we'll be receiving some payments. And this sort of when you in the reason you can make a high return on the stock market is that most people are not willing to put their capital at that level of risk. And so the average reward to the people willing to put their capital at that risk is what I would say quite high. And then if you really have some capital that you do not need, that's sitting there earning a low interest or something, a lot of people, it makes sense to put that capital at risk and say, you know what, I can lose this, but the average reward year after year after year for putting this aside for investments, potentially over several decades, is just really, really good. And then if you sort of, when you zoom out and see the long-term history of investing in companies, it just sort of those, even the great financial crisis, they sort of disappear in the big chart. Because there you lose half, but then you double, and then you double, then you double, then you lose half, maybe, then you double, then you double, and you just average that out and see over the long picture. It's like, it's really nice to be an investor. Like this is really the graph you're buying into.
Yeah, and you shouldn't even look only on yourself, or it's always look at others. You can look at it's Jeppe's history, stat history, and eToro. You can look at it and actually see, you can see some red month, but you can see the overall, and you can see the 10 years. And I think this is why it's so important, the visibility of the stats, et cetera. Just to see all of this, and actually you can see the long track record. And I think this is part of the trust you gain, like if I'm looking at it this way, because people really, they copied you for so long, so they know you already, and they know the month, and they kind of, also it's really, really important for everyone to really understand the market cycles, etc. I really, really think it's crucial sometimes to really, really understand it. I would love it if it's such an amazing year for you, right? It's an amazing year. And do you have any advice or messages that you'd like to share with investor as they prepare for 2025?
Yeah, I think people should take their finances seriously. I think, I see some people that are just putting everything on a stupid meme coin. I see some people that are just not getting around to investing. I think this is something that can make a big difference in one's life in the long term. So I just think people really sort of need to find the time to upgrade a little bit their knowledge of finance and start building a stock portfolio. And it can be done in many, many ways. But there's just a lot of people that are really sort of, I think, not getting the most out of their hard-earned money.
Mm-hmm. Yeah, that's amazing. That's a good advice. I think just before we dive into the Q&A, the question, I see some people obviously ask a question here. Feel free to ask more if you wish. And if we won't be able to take your question, we will go, and you can go to Jeppe's profile and obviously write it to him there. He loves answering, I don't know if he loves it, but he really is answering each, question, usually into details. This is also, I think, a big part of, the trust you have with your copiers, followers, and so-called community. I'd love having you here today. We're going to dive into the Q&A with you. But what a great webinar. Thank you for all the insights.
Thank you.
So I will start with this question. I think you kind of answered. What is your opinion on the sellout of yesterday?
Yeah, so we had a change in the 2025 amount of rate cuts that are going to be expected. So we're still expecting that to be rate cuts, but I think it was expected to be 4. Now it's more expected to be 2 based on what they said now compared to what they said in September. And the main change that a change in interest rate policy is a change in the money supply over time. And that really matters to bondholders and people that have a lot of debt, because it changes how much you'll be paying in interest rate. And companies, generally, they pay interest rate. And especially companies that are sort of not making any money for a long time and then will make it only in the far future, they are heavily impacted by this. And so a lot of the largest investors, when they see a change in the interest rate expectations over time, they want to have more bonds and less stocks, and then that caused the price to change. But it's not really been a massive change. It's a few percent. So it's, I guess, sometimes you gotta make a new story about something, and so a kind of in the grand history, I don't think we'll be remembering the 3% drop of yesterday for very long.
Mm-hmm. Okay. By the way, guys, if you have any more questions and that you'd like to drop in, as I said, we're answering here. So let's go to the next question. Sharam is asking, what are you suggesting for sources to collect information on the 3 key aspects you mentioned: finance, technology, and politics when analyzing a company? Better question.
So for each of them, if you're sort of starting just out, then the best is getting the foundational academic literature under control. So you can't really learn finance from YouTube. Unfortunately, most of the content out there is really bad. So you sort of have to go back to the core textbooks that you would get in university. And I think that's also the same for political science. For technology, it's a little bit different. There you can sort of learn by doing a little bit. You can always, just pick any tool and figure out how it works, take any, programming language and learn how that works. Then basically with any scientific subject, you can just dive down and read and read and read. And then you got to sort of test your learnings by talking to people that work with it. So I found it very helpful to hire tutors, PhD students in different topics, and then just I will tell them how their own field works, and then they tell me where I'm wrong, and then just by repeating that process, I sort of more quickly get to improve my level of knowledge in a field that I don't know enough about, and where I'm like, then there are some areas where you can those are the areas that I know very well. Sometimes there are some areas where I cannot myself be the expert, and then there the network becomes key, because then you have to know someone who is. So many years ago, when I was I had a friend who was doing his PhD at Oxford University in genetics, and then I got excited talking to him about that, and then I was like, right, I'm not going to understand the science here, but I can understand from the conclusion here that this is the company that I want. And then that turned out to be a very good investment. And there's other areas where I do that as well, like, right, I'm just going to trust you guys on this. And then I'll look at the financial statements. I will look at all of this stuff. But on this core thing, I just need you to say that it's this one, not that one. And then I'll trust that.
Amazing. I think it's a really good question. Someone is asking here. My question is, I think, okay, I think it's a bit for me. What is the minimum amount that needs to be invested? I said it first, yes, but he wasn't that fast. Is there a time of a year when it's good to copy? After we copy, can the person we copy open and close position without us doing anything? I don't really understand how it works. Okay, so first, great question. I like this question because I think a lot of people like kind of afraid to ask some questions, and it's really, really good when you really ask like, what is actually like how the copy mechanism actually works. So obviously when you get into eToro, there's a lot of, teaching about it, etc. But I would love to explain it here in like a few words. Basically, when you're copy trading someone, the minimum to copy any person is $100. This is the minimum to copy. When you're copying someone with, let's say, $100, and he has, positions, let's say in two companies, 50 and 50, you basically buy this company, according like in the same percentage, 50% Tesla, 50%, let's say Bitcoin. I was very volatile in my choices. But let's say you chose both of these companies, and then when the popular investor that you're conducting, like making any moves, let's say buying or selling, you are also buying and selling. You don't need to make any moves. The popular investor is the one that has to make the move. He's thinking, he's conducting the research, he's doing everything. You just need to copy him. Jeppe, on the other hand, because he is our top popular investor, he's approaching $100 million of AUC. In mid-January, his minimum copy amount would be $20,000, meaning that right now you can still copy him with $100, but in the middle of January, you won't be able to do it anymore. So I hope I answered your answer, and if not, feel free to continue it there. Let's go, obviously, if you have any, answer to add, feel free to do that.
Yeah, I think there was also a part about what time of the year. And here, effectively, the day you start copying, you will be in the same boat as me. So today I have certain assets in my portfolio because right now I believe those are the ones I want to have. And in a couple of hours, I might change my view on that. So if you copy then, again, whatever time you choose to copy, at that time, you'll be investing in the same things that I have in the same proportions. So if I thought right now it's best to only have cash, I would only have cash. So at any given time, like that's the portfolio that I want to have right now. So that's the time you'll be copying me right then. So you can't really say like September is going to be a good month. It's like, right, if I like, then I wouldn't have my money invested the way I have right now. If I thought now was a bad time, like then I would be holding something else. If I really thought like I should have bonds or commodities and things instead, I would be buying that. I wouldn't be telling people like, don't copy me and go buy oil instead. I'd be like, I would buy oil.
Mm-hmm. So I think it's also like important to note a lot of people always, copying you when you're green and then uncopy, not just you, like a popular investor in general, copy when someone is green and then uncopy when they're red and they don't really understand the whole effect of the long-term investment. And actually, I have a question about it here. Someone is asking if I invest 10,000 euros for the long term, what potential returns can I expect? Should I be prepared for my investment to decrease in value before it grows? Or is it possible to consistently see positive returns without experiencing any losses? Yeah, but do you want to answer that?
Yeah. So first, there are no guarantees. Hypothetically, it can go down to zero. I invest in companies that I hope and believe and do my best to evaluate that they will have the products and services that we'll all need in the future, but they might not. They might get out competed. Their products and services might suddenly suck. There are so many things that can go wrong with companies, and so they might all fail. That's just something you have to do. It's always best to invest money that you can afford to lose. You can't really buy into the stock market and then say like, oh, but I certainly don't want to lose more than 10%. It's like, no, you should be prepared. You can lose it all. Like the markets can go down significantly. They can also go up. Historically, markets have on average gone up by 7% in real terms per year. In the time that I've been investing since 2013, my portfolio has gone up by 25% per year on average, but you can't just necessarily carry that average forward into the future. I pick out the assets that I think are the best ones to have right now and that I think can go up a lot in the future, but there's just no guarantee of that. So you are buying into something that has multiple potential outcomes. And the best way to think about it is sort of, imagine me in many different scenarios. Like I imagine there's going to be a future happy Jeppe and a future sad Jeppe, and I'm going to make sure that there are more future happy Jeppes because, in the scenarios where this happened, in the scenarios where that happened, and both of them Jeppe was okay, but in those of them Jeppe was actually very good because, he did have those stocks and they protected him here, and that's sort of how I like to think of it.
Yeah, and also if I'm looking, if everyone looks at it, we just discussed it before. If we're looking at the long term, obviously past performance does not indicate for future performance, but you can see in the past that every investor had some red months and some good months, and you just need to kind of like see there also the growth. Also, yeah, as I mentioned before, like if I look at the past 10 years, you can see some bad months, some good months, but overall you can see the value that grew so much over the past 10 years. I don't have the correct number right now, but it's really good numbers. So we're going to take some more, a few more questions. We got a lot of questions. So guys, I just have to mention that if I do not, we do not manage to take your question, feel free to just go to Jeppe's, profile. He loves answering questions. He's good at answering questions and he will answer in detail. So I just have to say that. Let's take another question. What do you think about cryptos? Interesting.
So in general, I'm not a big fan of blockchain. I don't think it's a very good technology. And crypto as a wide space, I'm not very interested in either. I specifically have and like Bitcoin because I do think that having a currency where the money supply just keeps growing is not very nice. Having money types that are really connected to single countries is not optimal. So I think Bitcoin is simply just a better currency in that way. Now it comes with its own transaction system on the blockchain, but I think in the long term there is a good potential for us to be using other systems for transacting in Bitcoin, second layer technology, and then using that to actually, transfer values between each other in a quite easy way. And if that becomes the case, then Bitcoin can reach a very, very high value. And that's what I've been, investing in with Bitcoin all along. And that's, I think there's potentially other ways that you could do a currency for the world, not for all of the world necessarily, not for everybody everywhere all the time, but for a large part of it that could be even better. But I'm not seeing those yet. If we see some other cryptos potentially really improve technologically, like I think, Bitcoin being sort of stuck in the same way and other cryptocurrencies having different innovation. We're like, oh, it's kind of cool what this one's doing. Like, oh, now Ethereum implemented this thing that the other one was doing and so forth. That gives other ones potential over the long term where you're sort of like, right, now with all of this in place here, and if that becomes the case, I might switch to another one. But until then I think I'm very happy with just having that little part of my portfolio that I want to protect me in case of suddenly the US dollar, becoming really, really poorly managed. That little bit I want to keep in Bitcoin.
Mm-hmm. Interesting. That's interesting stuff, especially with the rally, with the recent rally, etc. But you mentioned that you have Bitcoin. I know you have Bitcoin, so amazing. That's interesting. Someone is asking, I think this question is for me. What happens to active copy under $20,000 in January? Will my copy be closed or existing copies go on as normal? Existing copies go on as normal. Don't worry, if you already have a copy, nothing wrong, nothing will happen to your copy. You can, Jeppe, you keep on copying Jeppe will still be open for existing copiers. Obviously you have time to still copy Jeppe with less than $20,000 until mid-January. Only after mid-January, new copiers will have this, entry, but the rest will stay as usual. So, yeah, so let's take another question. So many questions. Yep, a lot of people are asking you questions. Stock markets went up last 2 years. Do you think we are on the peak and perhaps we should have a higher cash growth to profit if markets dive?
No. I didn't catch that. Can you say that again?
Stock markets went up last. So basically, he's asking if we're at the peak right now, and if you have some cash growth to profit if markets dive. So yeah,
I don't think we are at a peak here. I think now is a great time to, you have to look at all the different assets. Which one do you want to hold? Do you want to hold cash that's going to get killed by inflation over time? Do you want to hold bonds that are earning a really low interest rate? Do you want to hold commodities that just stand there and do nothing? Or do you want to own companies that are really growing and making a lot of profits and are investing in a lot of good technology? Like, I definitely prefer to hold those companies based off the numbers right now. Then so a lot of people, they just really don't want to invest, and so what changes is just the excuse for not wanting to invest. So they're like, the market's gone up, they're like, oh, maybe it's gone up too much, I don't want to invest. Then the market goes down, oh, it's gone down, maybe it's going to go further down, I don't want to invest. It's like, right, okay, so then you're just going to be stuck not investing in either of those scenarios. You got to be like, right, okay, what is really the outlook for these companies? And even like most of the time, things are actually good. Even when there's a recession, companies don't do that badly. Like many companies that sort of, even if, their profits are lower, that it's not that terrible through that time. And even if the stocks are selling at a lower price, maybe they're selling in a lower amount of US dollars, but those are actually more valuable US dollars. That's a little bit partially what's happening when you see a trade change in the interest rate. They're like, oh, stocks are now worth less in terms of dollars, but actually those dollars are worth more. So there's the impact you're seeing is slightly less, although it also goes in the other direction. When the US dollar declines a lot in value, then stocks can seem like they're much more valuable when measured in US dollars, but it's just the US dollar is worth less. So sort of like almost half of that crazy volatility you're seeing is actually just the currency rate that's changing, and that's sort of and given that the money supply keeps growing, there is constantly inflation. It's just nice to have those assets that are on average going up a lot, even if the journey upwards includes some sort of like downtrends. And I think right now, I don't think now is a great time to be holding a lot of cash, and I don't think it's a great time to be holding a lot of bonds compared to stocks.
Mm-hmm. So we have another question here actually asking, what do you think about 2024? And if you have, and I think it's kind of the same answer, but if you have some cash, aside that you keep to when let's say the market, I will just read from it, but the market will, let's say, have a correction for 2025.
I have a very little bit of cash, which is only because of some, I think, 2 small dividend payments, very, very small ones. And so when if I sometimes if I close an investment or receive dividends from some of the companies, there'll be a little bit of cash for a while. Sometimes it can take a little time before I deploy that, and sometimes I deploy it immediately. But I generally don't keep a big amount of cash ready for when the market declines, because I think, yes, then we wait and then the market declines, but probably on average, each time you do that, you lose out on that cash. And so it's effectively on average better to have that invested in stocks and then just take those hits when you get them. Like, yeah, the market went down a bit, that's too bad. Okay, the market went up again. Okay, the market went down again. And then over time, that's much better. The people that are constantly like trying to say, oh, now we're taking risk off. Oh, now we're sitting in cash a little bit. They don't accurately manage to time when they're in cash, and so all they're doing is just lowering the average return, and on top of that paying extra fees because you sell some of your stocks to keep a little bit in cash, you employ it again, you take it out again, you're just paying unnecessary fees for this. So this is just when you add that all up, it can actually be quite significant how much lower performance those kind of investors they have over time.
I'm gonna take another few questions because they're keep on coming. If we'll manage, we'll take some more. We'll see how much we'll manage. So are you preparing for times of crisis? It is said that the global economic crisis, like the one in 1929, obviously, will soon occur. So obviously, by the way, it's funny because I think like we thought that the correction will come this year or last year, and
I mean, I guess that's one of the things that I have researched the most. I did my high school project actually about the
wow.
1929 crisis, and I did my bachelor's thesis in university about the Great Financial Crisis. So I've always been really, really interested in the financial crisis, and I've read extensively on every one of them. And it's something that you almost like, if something happened that never happened before, you're allowed to be surprised. But if something happened that happened many times before, like, can you really be allowed to be that surprised? So we've had financial crisis before, so of course we're gonna potentially have financial crisis again. So that's something you have to be prepared for. And I'm always thinking about, what are the things that could cause this? Whenever there's something, like, I immediately try to get some of the big numbers and all, like, right, if this thing happen, are we talking about 1 trillion loss here, 2 trillion loss here? How much can they absorb? Are we talking about what is the central bank's ability to come in and protect us against this? Is like when for instance, the some of the large construction firms get in trouble in China. I was immediately looking at all of the numbers and comparing to the Chinese government, saying like, right, how much can they stop this? Is this gonna be like and then like, no. If you see how much money the central bank have, we see what they could do politically. If we see how little money we're talking about here, it's fine. So you sort of I'm usually very quick to get in and do those analysis when there is something that I think is extra risky, and then I spend all my day just doing research. So potentially, if there is something big, I can be slightly faster to react than others. And then there can be some black swans where a meteor comes down, suddenly the AI goes rogue, or there is a massive war, China invades Taiwan. There's all these amazing things that can happen. And yeah, for each of those, I've sort of thought through some different scenarios and have some different potential strategies in place where it's like, right, if that happens in that way, I can kind of do that. That happens in that way, well, I'm definitely getting rid of this in the portfolio. And then with all that in mind, what will happen might not be exactly any of my particular scenarios, but it'll probably be some mix of some of them. And I have sort of looked through I've trawled through all of science fiction, all of the different sort of like sci-fi games and role-playing games and all of history to really get every technology that could ever be invented, everything that could ever happen, and build my scenarios from them. So I really think, if something crazy happens, people are like, no one could have predicted that. It's like, well, someone at least had sort of some scenario that kind of resembled that and some idea for what to do in that situation.
Mm-hmm. Okay. There are a few questions on when is the right time to close a position to take profits?
Yeah, so I mean, that's at the time that something is even better. So you want to have the best assets in the portfolio right now that are the ones that can do the best in the future. And so it doesn't matter, whether your position is in profit or is it a loss or whatever. It's like right now, should you have Amazon? Amazon may have been a great investment in the past or not. Doesn't matter. The question is right now, is that the best asset at the best price you can have? And if it is, well, then you should have Amazon. If you already have Amazon and you should have Amazon, continue to have Amazon. If you should have Amazon and you don't have it, well, then get it. And if you have, then that's really the frame of mind for it. It's not like, if you're buying a position saying, oh, I have a target for this to go up by double, so I'm going to hold it until that happens. But by the time that happens, it's a new company. It's a new world. That company might have gone up in value by a factor 4 and the price only went up by a factor 2. So now it's twice as good investment. So you shouldn't be getting rid of it right now. That's often the case. So every single day I have to evaluate, is this company right now really valuable compared to its price? And for that decision, it doesn't matter at all whether it, came from a high price or came from a low price. Is the only price that matters is the price today. And the thing you're buying, that's, what you're getting, that's the company today. So yeah, that's how I make my decision for what to have in the portfolio, and thereby what I have to sell to get rid of or to buy to add.
Yeah, I think it's very interesting answer. It's like I like the fact that you mentioned you're basically buying the company today. Don't look only at what you like when you initially buy, like you're basically also buying the company today, and every day is the day you're kind of buying the company if you hold it. So it's really always important to remember that as well. So someone mentioned that I should start using name, but Sean mentioned that I began following him recently. I would like to hear about his experience and strategy for 2022, a tough year, how he handled the bear market and what was his asset allocation and how did he manage the risk. Thank you.
Yeah. So early on, when COVID struck, I had I was already working from home, so I was quite well aware that that was going to be a big thing. And so I quickly evaluated all my different companies to see which one I thought would be winners, neutral, or losers from COVID, and then adjust my position based off of that. So you might have a company that would be good under all circumstances, but it's just even better because of this and even worse. So the adjustments made there ensured that I had the right companies for the preceding couple of years. And then effectively the reactions towards supporting the economy from the central bank, they made stocks go up a lot for a while and then down for a while and back up for a while. But I was invested based on that whole trend and turned out to be really good. And then if you sort of see my portfolio on the way up had the similar high returns of like NASDAQ and ARK, but then on the way down, I had the like the drawdown more equivalent to SP 500. And that sort of helped make me get way ahead of other investors, because the other investors that had been going also been performing well as me, they didn't manage to protect the downside when that happened, but I did. And then that sort of left me in a quite unique category of having had that high return on the way up, but only the normal decline on the way down. And so even though I also declined in that period, it just declined by less than the competitors that had that similar high return. So it was sort of in that way, even though it was declining, it was extremely good for me that I declined less than the competition, just in, in that little game of having the highest total returns.
Mm-hmm. Interesting. We'll take a few more questions. Obviously, we don't want to, we are already over time, but we're enjoying our time. So we'll take like a few more minutes and like, let's say 2 or 3 more questions. But I have an acceptable performance on eToro. How can I do it professionally and jump into the finance world? Must I go to university again? My background is engineering. Thanks in advance. I would love to answer that, but I would love Jeppe first to hear what you have to say about that.
Yeah, so when you start out on eToro, the first thing is to be able to build a nice portfolio, and for that it's already great to start learning about finance. But that might just mean picking up the textbooks or taking some courses. It might not mean necessarily the whole education, because you can also be good in a specialized area. So you might have some people that are great oil traders, and they need to get the financial knowledge, but it's built on top of the fact that they're already a great petrochemical engineer and know a lot about the oil industry, so they can be a good investor from that. Then if you want to be a popular investor on eToro, you need to live up to the different requirements. So at a certain level, you have to pass a course from the Chartered Institute of Securities and Investment. So then you got to read the book and pass the exam, and then if you can do that, then you're good to go. You need to have a certain amount invested, and do well, keep your risk score in check and that stuff. And those are sort of the requirements. Then in addition to that, if you want to do well on eToro, I think you also have to answer the question, sound professional, and explain what you're doing, so that when if people get some legitimacy from for instance another investor said something really smart about some solar companies, and then when they went up and did that, it's like his investors now like him because they remember he said that thing, and then when he was right, it wasn't like, oh, he randomly got lucky on that thing. They remember like, no, he specifically bought those stocks and he said why he was buying them, it was for that reason. And when we saw that thing, like that helps build sort of a profile over time, that when then people see, okay, he's done well, what he said would happened, and then if you live up to those requirements, then I think you can build it from there. And then how ambitious you want to be with it, it's I think investing your money is just it's a great thing to do, and so if you're doing it well enough, it can become your whole life basically.
Yeah, and I want to add that I really like your answer. I think you touch all the points. I just want to add like something small, like regarding the fact that what I really like and what I think one of eToro's amazing thing is that you don't have to have the specific right background to be an investor on eToro. First, you can always copy another popular investor and kind of like understand from him, understand like what's because he has the right, he learns a lot, etc. So you can just copy him in order to invest, and you don't have to start learning from scratch. The other thing is, even if you don't have the right background and you want to start learning, the knowledge today, unlike back in the days, today is so like available. You can just like gather information from everywhere. So I think it's also important to know that always read books, learn, don't stop learning. The world is evolving. It doesn't stop in like 3 years in university. It's always changing, and it's always good to learn and study and understand about investment also in the like The Intelligent Investor, for example. It's an amazing book, for someone to understand the investment world as an overall, I think. And also, it's like start already, like kind of understand the world. When you start, I think you understand more and more. Yeah, so this is my cup of tea. I'm just going to take another one question, and then guys, I know you're asking so many questions here in the comments, and I we really want to answer all of it, but we're kind of going out of time. So I'm going to take like another question. So at the moment, many stocks are at high levels of the year, or even have or had hit at all times high. And the indices are very high, obviously. Is now the time to open copy of your portfolio, copy you? How will you handle potentially sharp falling prices, as many media are predicting it for 2025? I think you answered that already. Will you keep cash reserve? You also answered that. So
firstly, in terms of
another one.
Because the market is on average generally going up, we are often near all-time highs. Like that's just that you will very often find yourself near all-time. So people it's now a time because it's near all-time highs. It's the way the most money have been lost over time has been waiting sort of for markets to decline. Similarly, people are like, oh, I want to buy a property, but I'm gonna wait for price to come down, and then they sit there 5 years later and they're like, now prices are even higher, but I'm going to wait for them to come down, and then they get even higher. So I think that's more often the case. In terms of if there is a recession or a financial shock of some kind, then it depends on the exact situation, what I will do in that case. I'm not going to try to like guess that now we're going to head into a recession and I'm gonna outguess the economists and the big banks and sit with a lot of cash for that. But there might be a situation where I'm going to try to find some value from saying like, I think that people are going to reduce their risk by having these assets, and they're doing that too much. And there's some other assets that I can use to reduce my risk that other people haven't really discovered. And so I'll be more positioned in those, because effectively, sometimes you can find alpha, make your portfolio better by finding something that'll give you a higher return for the same risk. And then you can find something like, oh, this will give me the same return, but with a lower risk. And so it's always an art of finding those, and some of them having them ready in the portfolios, and others having ready, just in the financial models for when suddenly the prices and the facts change that cause them to suddenly be really, really interesting investments. And then in those cases, that can suddenly mean that, markets decline a lot and everything goes down by a similar amount, like, right, yeah, but not everything should decline by that amount. There's some that, should have actually declined by more. There's some that should not have declined by that amount. And I'm going to be then positioning over from that. And then potentially on the way back up, it's going to be then, those ones that went down too much compared to how much they should have gone down, they're actually rebounding by way more. And I'm disproportionately more invested in those.
Okay, so let's just take another last question, and then because we're just going to take another one question and that's it. And then I see that all of you guys are asking a lot of questions about the minimum copy, etc., etc. We addressed it during the webinar, but Jeppe will post another post explaining everything in details, explaining exactly everything. And if you have questions, just pop up into his portfolio, into his eToro profile, and we'll answer everything. And we're here for that. And he's here, and he would love answering your comments, right? Yep, I'm sticking by your name, basically.
I didn't like it. I sometimes also learn some questions. Sometimes people ask me about something like, what do you think about this stock? I'm like, I don't know. Look at it, and I'm like, this is kind of interesting. Then I look at, what suppliers do they have? Oh, suppliers kind of interesting. Oh, what do they do? Oh, they're using this new thing. And then, then I get dug into something, and suddenly from that comes some some idea. So yes, it's nice to have 30,000 people that come from all over the world, from all sorts of different industries, asking all sorts of different kind of questions.
Yeah, so just like the last question, apologies for everyone for not being able to answer all of your questions, but we'll take this last one. And as I mentioned 100 times, just pop into Jeppe's profile, he will answer everything. It's just his name. Search it on eToro, JeppeKirkBonde. Jeppe, it took me a while to understand if you're Jeppe or Jeppe. I have to say that.
So in Danish, we say Jeppe. So yeah, that's how I say it.
Spanish, it would be Jeppe.
Maybe, yeah.
Maybe. Anyway, how big of a part model plays in your investment decision? Do you recommend anyone who is interested in investing to dive into modeling?
Dive into modeling.
Mm-hmm.
Yeah. So I think there is an overlap if that's if that's like your job and you're being paid to make models. If you want to make the best investment, you have to do financial modeling. Like you have to. It's not enough to just sort of that's sort of where the finance, politics, and technology bit comes in. If you look at like a company like Netflix that I invested in many years ago, like I was watching Netflix, I could understand Netflix, and there were other people that were technology buffs that were also interested in Netflix, but they couldn't really decide if this was a good investment because they didn't know like right, so it's a good company, so should it cost 1 billion, 10 billion, 100 billion? What should a company like that cost? What kind of money can a company like that make? You have to sort of square that knowledge of the subjective view of the products and service and whether people will like this or not with how much money is that actually going to make. And for there to see how much money things are going to make, you sort of have to you can't keep all those numbers in your own head. Although sometimes they say the best investment you can do it like on the back of a napkin, you'll be like, right, that's worth 1 trillion, that's a half trillion, so it's 1.5 trillion, good. And if the company only costs 200 billion, like, right, that's so good that's more than fine enough. I don't have to. But then you might as well, because you also learn something from doing it, like looking through all those numbers, getting into the detail, looking at like, oh, why are they making this other product? Oh, I wonder if they made this kind of product, and just doing that exercise is it's a fun way of looking at the world as well. Like I look all around me, I'm like, oh, paint. Well, I know companies that make paint. I know companies that supply the paint companies, and you're like, when I walk around, I really want to know that everything I see, I'm like, I know how that's made. I know what kind of companies make that. I know how much money they can kind of make from making that. I know how much is being sold from that. And I like just walking around the world with that mindset of just being like, all of this is made by different companies, and I can invest in these companies, and yeah, I like that.
Okay, amazing. So the last one wrote, so there's a lot of many questions, as I mentioned, just go into the Jeppe's profile, but this, it's not a question, it's actually, can we have more such interviews? It is very helpful and informative. Thanks, both of you. Thank you guys for participating. We loved having you here with us. We would love to have more questions like that, maybe next quarter, maybe in the next, milestone, Jeppe. It was amazing to have you as usual. Looking forward for 2025, and thank you so much for participating. I hope you enjoyed.
Thank you very much. That was very enjoyable.
Amazing. Bye guys.